Alright, I want to do a real brief video on why I like covered calls. Okay, so for example, in this scenario, right, let's just cover this up, right? I'm looking at this and I'm going, alright, this is ranging, right? After this little uptrend here, it was ranging and I'm completely fine with that. And I was like, okay, it's pretty consistent within this sort of, it was pretty consistent under 44.5 to 45. So looking at this range, and looking at it approaching the top of that range, it was like, well, I don't want to short this. It's on a short-term bullish move, right? So I don't want to go trade against a trend on almost any time frame. That would be silly, right? But on the other hand, it is sort of approaching an important moment here. And I do see some potential in this. I see some potential swing coming in here. So what I did is I bought 200 shares right around here, like at roughly 43, right? Like, let's say 43. I'm not sure where I bought it at. Somewhere around 43. Okay. Anyway, so instead of just buying the shares and that's it, what I did is I sold one covered call. So that means that in case this moves up sharply, right, because it's sort of approaching the resistance line, if it does break that resistance line, which I don't want to wait for right now, right, because I expect it to move down by that time, right, if it breaks through, then I can sell 100 shares at quite a steep profit, or well, steep. I mean, that's a nice, let's say, 5% gainer, potentially, right? Okay. And of course, I am using margin, so I do get a little bit of leverage on these positions, right? So that can run up a little bit. Okay, and then the next part is, if this does move down, I am profiting off of the covered calls premiums, right? Now, because this is ranging, in that case, I do expect it to recover, right? So I am very confident with this double bottom, as you could call it. It's a little bit far apart, so it's not really a clean move up down, right? It's not really a clean double bottom. This is seemed like a very strong line of resistance here. I wasn't really afraid to have to hold this, right? I really felt confident, like, okay, sure, right? If you look at this, if you draw this on to this area, you see this is quite strong, right? And then you have another area right here. So I think the chances of this dropping really hard are very, very slim. And yeah, I feel quite positive that the downside potential on this is quite low. Okay, so in this case, it moved, as you can see, it moved quite significantly, right? So it went past the strike price for a while, didn't get executed. So what I did is I sold 100 of these shares at this profit of, let's say, $3 per share. So that's like $300 profit. That's good. And then what I did is I expected this to range back down, but it didn't. So then the other 100 shares just got called away. Now, I'm not really bullish in this in the longer term, right? I'm not considering holding this for like, months on end. I really don't feel like it, right? If you look at this stock, I haven't really done a lot of research on this. But if you look at the PE ratio of 74, right? That's crazy, man. That's crazy. Earnings per share of below 1. I really don't like to hold this on the longer term. I think this is just being traded, and eventually it'll just crash. But the problem is we have no idea when, and maybe it won't. Maybe it won't. Point is, with this covered call tactic, right, I was able to essentially try and eat my cake, or have my cake and eat it too, right? So in this case, when it didn't range and instead broke out, I still got profits. And if it does hit the bottom, as long as you're right that it does range back, then you are still in the green. So you have to sort of be wrong twice. It's like an extra level of confirmation, right? So in other words, short explanation of this, right? If you're approaching sort of a high and you expect it to break to the bottom, but you're not that confident that you're willing to short it because it might just break through resistance and soar up, then this covered call strategy is quite nice, because what you're saying essentially in the case of a covered call is I am okay with holding this stock. So you gotta find stocks that if they do move quite far down, you're okay with holding it at a low point at, let's say, at a negative value, but taking into account the fact that you got premiums, right? Now, a good example of the difference here, like where's the downside, right? Obviously, the downside in case of a covered call relative to when I just, let's say I would have just shorted the stock, well, then I would have just got stopped out really hard and just lost money, period. That's it, right? And my gains would be quite nice if this stooped down, right? And I could profit off of that. But I was wrong. I would lose money, right? Now, if I just bought the stock, that would be entirely different as well, right? Because then in any case of a downward move, I'm just losing money and that's it, right? But in that case, obviously, the upwards potential is larger. But that's the thing, right? I really think this is overbought as heck in the short term. So if you're thinking it's overbought as heck in the short term, then that doesn't make a lot of sense, right? It's the same thing as, let's say, when you think something's overbought, you think you're bullish on the long term, but you expect a pullback on the short term, right? But you're not very confident, then you can use this strategy. Right, so you might say, well, why not just short it? Because you're trading against the trend, right? You don't want to do that. And you can see here what happens when you trade against the trend. You lose money, right? So let's say if in hindsight, you know that every stock whipsaws back and forth, right? You know that. That's just a property of stocks, right? They whipsaw back and forth. But the problem is you can't really define the length of the whipsaws very well. So let's say this goes to 50 and then pulls back significantly. If you look at this later, it just looks like, oh, this was consolidation, and then this broke out, and that was really good, right? Like, it almost looks like a bull flag even. But the thing is, that's hindsight. Right now, it just looks like it ranging, right? So when you add that move in and you look back on it, you might confuse this and say, oh, that looks like consolidation. But that's only taking into account the price action that didn't yet occur back then, right? So that makes it very hard from just reading price data to determine where is the top, when is it going to reverse, right? So to become less sensitive to trying to time the highs, you can use these strategies such as covered calls, right? When you think it's going to pull back but it's going to swing, right? You're not that confident when this is going to occur, so you just keep collecting premiums, or even just if it does go up, keep going up, you collect money. If it goes down and then it goes up, you also collect money, right? So in the only situation in which you lose money is when when you were wrong on the overall trend. That's the only way you will lose money here. So it's a nice little way of redefining your strategies using options, right? You get a lot more bang for your buck in these kind of scenarios. All right, hope you enjoyed that, and I'll see you in the next one.